Hi everyone, sorry I couldn't be there today. Um, my role within Actavis has been the Chief Financial Officer, and I'm looking forward to explaining Actavis's current financial situation. So as Dan mentioned earlier, Actavis is focused primarily on the generic drug market, and in terms of our financial statements, we have reason to believe that Actavis is financially stable and will continue to grow due to their strong balance sheet, skyrocketing cash flows, and increasing revenues. Well, there are some areas that might seem concerning, such as net income in our income statement. We believe this is a small setback that will, in the long run, produce incredible returns and be accretive towards our overall earnings per share. So now let's jump a little bit more into detail and see what Actavis's true profitability is currently looking like. So as you can see, we have had incredible growth, almost double what it was 2 years ago. And while cost of goods sold has also grown, our gross profit doesn't seem to be greatly affected, as it has also tremendously grown. Unfortunately, due to the acquisition of Allergan, we have recently seen a fair amount of increased costs, which you can see in items like depreciation, unusual expenses, R&D, SG&A, all of which are causing net income to be negative. However, our team at Actavis believes that we have substantial synergy waiting to be tapped into because of Allergan, and that will be seen most likely in the next year. These costs will thus not be as impactful once those synergies are realized, as revenue will grow at an even faster rate. So now let's take a look at our balance sheet. On our balance sheet, our total assets and total equity have almost quadrupled in the last 2 years. While liabilities have also grown, we believe that we're incredibly efficient still, considering our total debt in comparison with our total equity is fairly small, which I'll talk more about later. And cash and cash equivalents have also steadily grown over the last 2 years, which is always nice to see, because cash at the end of the day is always king. And so speaking of cash, let's now break down how Actavis has been inflowing and outflowing cash on their cash flow statement. Again, we feel strongly about our firm because inflow has been drastically increasing the last couple of years. Our total cash from operating activities has almost doubled in the last 2 years, while we continue to pay down debt and make certain investments. While our net change in cash isn't substantial, this is because we had to pay a fair amount of debt back for acquiring a lot of debt to acquire Allergan. However, now that we have ownership over Allergan and have responsibly been paying back debt this year, in the next few years we should see a rather large increase in cash, thus putting us in an even more liquid position than we are already in. Now you may be wondering at this point how these grand changes to our firm have been seen by other investors, and therefore how our price has done in the last few years. This slide shows how our stock price has done in the last year. We were around $160 in late 2013 and are now almost at $280. The last upward lip in mid-November that you can see represents when we acquired Allergan, and we have seen bumps along the way, but it is apparent that our price has been overall upwards trending in the last year. This upwards trend is even more visible for the price over the last 5 years. In 2010, we were around $36, and as I said before, we were around $280 now. That's around a 700% increase. And on the next slide, in comparison to the Dow Jones, which has also done remarkably well in the last 5 years, we still have visibly trumped their gains. Here we see a brief overview of our company's main multiples. So market cap was around $7.71 billion 2 years ago, and it's now 10 times that size because of that acquisition of Allergan. With the amount of cash we now have and big enough balance sheet, we believe that we can make much bigger decisions that can help realize even greater returns in the future. Our quarterly revenue this past quarter has been huge, with an overall increase, as seen on the screen, is 83%. The ROE is negative simply because of that net income. We believe that this will soon change for my reasoning later. To give you a better sense of where we stand against some of our top competitors, Mylan and Tiva, for example, and I chose those two mainly because they represent similar geographical and customer type markets. We can see some basic ratios. So our PEG ratio shows that we have a strong growth rate and that our company is arguably currently undervalued, along with our gross profit percentage being the highest out of the three. ROA, ROE, and ROI are all simply negative because getting back to net income, it's still negative. But once that synergy, as I've said before, from Allergan becomes visible, these negatives will be flushed out and our true value will be shown. Our quick ratio is a reflection of the cash we essentially should in total have and is the highest out of our competitors. Our current ratio is a close second, and our interest coverage is negative simply because, again, our recent increase in costs has caused net income to be negative. I think one of the best parts about Actavis's financial health is how little we rely on debt compared to our competitors. Our total debt to equity is incredibly small, and both our debt to assets ratio along with our long-term debt to total equity are close second places, showing that we don't really rely on debt, and we're paying back a lot of our debt as it is right now, so we're really not a company that is skating on thin ice in really any way. And to finalize our metrics, I wanted to talk a little bit about the Pratt analysis of Actavis. Profit margin is again negative due to net income. The retention ratio has been 1 for the past 3 years, and that's simply because we don't issue dividends, or pay out dividends, I should say. Our asset turnover has somewhat slowed down, but I don't think that's that much of a concern, mainly because net income again. And then financial leverage is decent. It came down a little bit from 2012, which was good to see. Sustainable growth, again, negative in net income. And actual growth, that really shows that net income shouldn't be a factor. I mean, 48% increase shows that we really are a growth company, and that in the next few years we're going to be incredibly profitable. And so now, just to wrap up my portion of this presentation, I think there's just a lot of exciting things about Actavis, especially in a financial health point of view. I've talked about multiple times now, the synergy is just the key to really showing the overall value of this company. And I think this is an overlooked stock, and definitely a buy, mainly because a lot of people are concerned about that negative net income. However, it really shouldn't be, because Allergan is the top Botox maker in the world, and once we realize those revenues, we're going to be in a great financial position. Debt, as I've already mentioned, is not a concern. Our stock performance is through the roof. We've done very well, and that shows how strong of a company this really is. We're liquid. Our quarterly revenue growth is unbelievable, 83%. You don't see that too often. So this is just really a growth story, and I think Actavis is a great company to invest in right now. And with that, I will turn it over to Peter.